Hi, my name is Scott Shuttleworth from Montgomery Investment Management and welcome to this week's video insight. Today I'm going to be taking you through DuPont Analysis, which is a powerful tool for analysing why exactly a company is profitable. Now, it divides profit into three factors and we'll be going through them in turn. But firstly, let's have a bit of a look at the context and history of the DuPont model. Now, the DuPont model was first devised by Frank Brown, who was an electrical engineer at DuPont. Now, in 1917 to 1919, DuPont acquired a position in General Motors, and Frank was asked to have a look into the company and see, well, what have we actually got here? He devised a series of financial ratios and some financial management tools, and one of them was the DuPont model. So let's take a look at it. Now, as we know, return on equity is simply earnings over equity, but DuPont Analysis allows us to break this down even further into these three factors: earnings over sales, sales over assets, and assets over equity. So let's look a bit further. We can call each one of these factors a name. So as I said, the earnings over sales factor we can call the net profit margin, as we know. The sales over assets factor is a scale factor. For example, if I put in $1 of assets, how much sales can I get from that asset? And the last factor, which we'll go into more detail later, is the leverage factor, assets over equity. Now, we're going to start up a company, and it's under the inspired name of Lemonade Stand Pty Ltd. It's been running for a year, and it has a set of financial metrics. It's got sales of $10, profit of $2, assets of $10, and equity of $10. Let's use the DuPont framework to have a look at this company. Now, as I stated earlier, its net profit margin, earnings over sales, is 20%. Its scale factor, i.e. sales over assets, $10 over $10 is 1. And its leverage factor, assets over equity, $10 over $10 is also 1. So if we look at the return on equity for this company, i.e. this one, we can see that most of the return on equity is driven by the net profit margin, not so much these other factors. Let's start up another company and see how we go. Now, another company that we have here is under the inspired name of Pencils R Us Pty Ltd. Pencils R Us has sales of $100, profit of $2, assets of $10, and again equity of $10. Let's use the DuPont framework. We can see that the net profit margin is very, very low at 2%. But what drives the earnings for this firm is the scale factor at 10. And then the leverage factor, again, doesn't contribute that much. So we can see that for this firm, as I said, the returns on equity is driven by scale. It's sort of akin to Walmart if you think about it. It invests a lot, but then it gets massive sales over its assets. So our next company is Worldwide Trading Concern Pty Ltd. It has sales of $10, profit of $1, assets of $10, and equity of $2. Now, its return on equity is a massive 50%. That's generated by the net profit margin of 10%, a scale factor of 1, and a leverage factor of 5. So whilst net profit margin does contribute here, the main factor is the leverage. So now that we've seen a few companies and we've seen what really drives their earnings, we can start to ask some questions. So for example, for firms that have a high net profit margin, we can say, well, obviously the returns of this company is linked to that net profit margin. So why is that net profit margin persisting? I mean, Lemonade Stand Pty Ltd just makes lemonade. It's quite a commodity good. But it must have some certain quality. It must be of a certain flavour for people to be willing to pay the margin. If you suspect in the future that that's not going to be sustainable, well, you might have to reconsider investing in that company. What if scale is driving the return on equity? Well, how does that scale come about? Did they have to invest, billions and billions of dollars to be able to get that scale? Do they have to have some kind of patentable technology? Do they have to devise some technology? You can always ask these questions, find the answers to them, and then see, well, can competitors replicate that? And finally, leverage. Now this is a bit of a tricky one. So firstly, obviously a bank or something like that would have high leverage, and if you invest in it, then you have to consider that risk. But if it's not a bank and you still see there's high leverage, then you have to ask yourself, can the firm, what's driving that leverage? It could be debt, and then you have to ask yourself, am I willing to accept that amount of risk? Or it could be some other factor. For example, the company might get a lot of inventory from its suppliers on very good terms, 360-day terms. And if it's a piece of inventory, you might consider, well, they can probably sell it within 360 days. And in that case, the leverage factor might be a strong competitive advantage for that firm. So these are the DuPont factors. I hope that's been useful to you. We will join you again next week, but until that time, please follow us on Facebook and Twitter.